Let's check in now with Craig Bolanos, the CEO and founder of Wealth Management Group. Great to have you on the show. And many investors have a portion of their investments in bonds, and that is a good thing. But what about the relationship, Craig, between interest rates and bonds and a retirement savings? Because that is critical.
Well, with there being more than 54 million Americans over the age of 65, I think it's probably a safe bet to represent that a lot of people have a good portion of their 401k, their IRA, in a safe money asset that we call bonds or fixed income. And whenever you're a bond investor, it's mission critical that you understand the relationship between interest rates and bond prices. And maybe it seems odd that anyone's worried about interest rates today by looking at a long-term historical chart of where Treasury yields have gone. It's just been lower and lower for longer. But the reality is, if you don't believe we're going to go negative, I don't, then there's only one way for things to go from here, and that's up. And we've got some strategies that people need to know to keep the bond part of their portfolio safe.
As an investing pro, what are some of your bond investing strategies?
Well, let's start by saying what we're not going to do. Don't sell all your bonds just because interest rates might rise from here. Bonds are always going to have a place in someone's portfolio, especially when it comes to retirement, because bonds are the ballast that can help keep someone retired. That being said, if you think inflation is going to be paired with rising rates, there's three strategies you need to incorporate. And the first strategy is, of course, managing your duration. That's not as simple as buying short-term bonds. Managing duration means picking the right spot, the sweet spot at any given moment on the yield curve where you can achieve that concept of having the ballast, but also having not just a nominal yield, but preferably a real yield. And part number two, that's about what we call spread-oriented exposure. It's having bonds in the portfolio that are going to provide this higher coupon than we can achieve just in treasuries. Think about corporates, asset-backed, mortgages, bank loans. Those are all examples of ways you can get spread-oriented exposure. And then last but not least, when it comes to managing bonds in a rising interest rate environment, think about going global. Have some global bond exposure. Sure, the world is more interconnected than it's ever been, but there is still some level of muted correlation when it comes to interest rates between developed and emerging markets, and having global bond exposure helps that diversification. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you want to learn more, you can. Check out our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.